For over 3 decades, the global manufacturing sector has operated under the just-in-time (JIT) philosophy, a Toyota-pioneered system designed to maximize capital efficiency by ensuring that components arrive at the factory floor exactly when they are required for assembly. This model sought to eliminate waste in the form of inventory holding costs, allowing corporations to maintain lean balance sheets and high return on invested capital (ROIC). In a stable geopolitical environment with frictionless logistics and cheap fuel, JIT was the primary engine of corporate margin expansion. However, we have now entered the efficiency trap, a state where a system is so mathematically optimized for a perfect environment that it possesses zero tolerance for systemic disruption. The global economy is currently undergoing a violent transition towards just-in-case (JIC) architecture. The objective has shifted from minimizing inventory to building strategic buffer stock to survive unpredictable shocks, be they viral, geopolitical, or environmental. For the investor, this represents a fundamental reallocation of capital. Companies are being forced to pivot from asset-light models back towards asset-heavy structures as they warehouse months of raw materials and finished goods. While this transition creates a permanent drag on short-term efficiency, it is the only path to operational survival. In the 2020s, the waste of extra inventory has become the premium for insurance against total systemic failure.
The technical vulnerability of the 20th century supply chain was its extreme geographic concentration, often driven by the singular pursuit of the lowest possible labor cost. We are now witnessing the Great Reshoring, a process where production is moved closer to the end consumer to mitigate the risks associated with maritime instability and geopolitical conflict. However, this is not a simple geographical shift. It is a complex technical maneuver known as friendshoring, the intentional restructuring of supply chains within a network of allied nations to ensure political continuity. This movement represents a fundamental break from the law of comparative advantage. We are no longer producing goods in locations where it is cheapest to do so. We are producing them where it is safest. This adds a structural layer of cost-push inflation to the global economy. As supply chains shorten and migrate to higher-cost jurisdictions, like the US, Mexico, or Eastern Europe, they require massive initial capital outlays for domestic factory construction and the development of specialized labor pools. The peace dividend, which allowed for the outsourcing of critical infrastructure to the lowest bidder, has been replaced by a security tax that is now permanently embedded in the unit cost of every finished good.
One of the most volatile technical phenomena in a destabilized supply chain is the bullwhip effect. This occurs when a minor fluctuation in consumer demand at the retail level triggers progressively larger, more erratic swings in demand as the signal moves upstream toward wholesalers, distributors, and raw material manufacturers. Because each layer of the chain adds its own safety buffer to protect against shortages, the data becomes distorted, leading to massive overcorrections and systemic inefficiency. During periods of high uncertainty, this leads to a violent supply-demand mismatch. Manufacturers, haunted by the memory of recent shortages, overorder raw materials in a panic, which inevitably leads to a massive inventory glut when consumer demand eventually cools or interest rates rise. This creates inventory booms, followed by inventory busts, leading to extreme volatility in quarterly corporate earnings. For the investor, tracking the inventory-to-sales ratio has become a more critical leading indicator than tracking top-line revenue. It reveals whether a company is experiencing organic growth or if it is simply padding its warehouse with depreciating assets in a desperate bid for stability.
The global economy remains precariously tethered to a handful of critical maritime choke points: the Suez Canal, the Panama Canal, and the Strait of Malacca. The technical vulnerability of these arteries has been exposed by a combination of regional conflicts, climate-driven water level changes, and the sheer physical scale of modern ultra-large container vessels. When one of these points is constricted, the result is a logistics cascading failure, where delays in one hemisphere result in container shortages and port congestion in the other. Shipping costs have ceased to be a negligible commodity expense. They have transformed into a highly volatile strategic variable. We are seeing a pivot toward multimodal logistics, where companies diversify their transport methods across rail, air, and sea to ensure redundancy. However, redundancy is capital-intensive. The infrastructure required to bypass maritime choke points, such as transcontinental rail expansion or modernized dry ports, requires decades of investment and high-cost maintenance. Portfolios over-indexed on companies with single-source maritime dependencies are carrying a hidden geography risk that the broader market has yet to fully price into valuation multiples.
The final, most persistent constraint on the global supply chain is the demographic cliff. In virtually every developed economy and major manufacturing hub, most notably China, the working-age population is entering a period of permanent contraction. This labor deficit is a structural headwind that cannot be resolved through wage increases alone. There simply aren't enough human units to staff the traditional assembly line model. This necessitates a technical pivot toward hyper-automation. To build a resilient supply chain, companies are increasingly investing in dark warehouses and fully autonomous manufacturing cells. These facilities are designed to operate 24/7 without human intervention, effectively shifting the cost of labor from variable, wages and benefits, to fixed, robotics capex and software maintenance. While this improves long-term stability and shields the company from wage inflation, it significantly increases the moat and the barrier to entry for new competitors. The winners of the next decade will be the firms that can successfully decouple their production capacity from human demographic trends by integrating AI-driven logistics into their core architecture.
A portfolio can survive the decay of the just-in-time era by reframing systemic redundancy not as inefficiency, but as a core source of durable value. Prioritizing regional champions with localized supply chains and domestic manufacturing that are insulated from transoceanic disruption. Accumulating stakes in logistics infrastructure owners, the custodians of the physical internet, such as deep-water ports, private rail networks, and temperature-controlled storage, whose strategic value compounds as global transit frictions rise. And backing the automation architects that supply the picks and shovels of reshoring, namely advanced robotics, computer vision, and industrial software that enable autonomous production in high-cost labor markets. The era of the global optimized system is over. We have entered the age of structural redundancy. In this new environment, the companies that thrive will not be those with the lowest theoretical costs, but those with the most robust and adaptable systems. Optimization for a single perfect outcome is now a liability. Optimization for a multitude of chaotic outcomes is the new standard of excellence. If you are still valuing corporations based on the efficiency metrics of the 2010s, you are missing the reality of the 2020s. Resilience has become the new alpha. You must invest in the systems capable of surviving the break, or you will find your capital caught in the wreckage of a global trade network that was built too lean to survive a world in flux. Thank you for listening.